I'm Jeremy Szafron. Welcome back to Kitco News. Well, it's been a turbulent week for the precious metals market. Spot gold successfully tested the critical $4,000 psychological support level just overnight and has since staged a pretty powerful rebound, now trading in a range between $4,100 and $4,150 an ounce on the spot side. Silver, too. I mean, it's mirrored that volatility, and it's reclaiming that $48, $49 level. Now, this price action is set against two powerful narratives that seem to be quite contradictory as well. First, a new institutional thesis from JP Morgan arguing for a structural shift that could see gold's price double. And second, a massive physical drain from COMEX silver vaults. Now, to make sense of this, you need to speak to someone who not only understands the system, but who broke part of the story open. Our guest today is uniquely positioned to connect these dots. Bob Gottlieb is a former executive at JP Morgan's Bullion Bank, the very center of the system. He's an expert in precious metals, and he has a new book coming out called Mastering Gold and Silver Markets, Insights from a Legendary Bullion Bank Trader. A must read for our audience, I must say. Welcome to the program.
Jeremy, thank you for having me. I'm a fan of Kitco.
Oh, thank you for saying that. It's guests like you, Bob. We get the insights to our wonderful audience, and I appreciate you making the time because we got to start with this week's sell-off. I mean, what a almost felt like an episode of something, to watch. Obviously we saw gold collapse more than 200 and then rebounding, silver dropped sharply, and then the volatility across the metals complex hit levels we haven't seen since early 2020. We've seen some recovery here, but let's get into the who, what, where, when, and why. What triggered this move? Was it a pure algorithmic liquidation? Was it the market telling us something deeper about liquidity and leverage? What are your thoughts?
Yeah, it's a great question. And, I think everybody that follows me knows that I don't believe that anything goes up linear. And we've had a tremendous rally. Even after the sell-off, gold is up 57% or so since the beginning of the year, silver up 69%. I believe what has happened is, so in the last month or two, a lot of pundits have come out and advocated for gold. You have Jeff Gundlach, El Arian, Ray Dalio, and many others. And matter of fact, Jeff Gundlach mentioned on a competitor network that gold has become a momentum trade, and that retail investors just getting on the radar screen with gold. I think what has happened is that a lot of retail investors in the last 2 months just got involved in gold. I would call them weak longs. And in addition to that, when we started stalling out around the 4,300 level, many people came out stating, well, maybe we've hit the top, maybe it's a bit frothy. You had one investment bank recommend a 60-20-20 portfolio where 20% would be in gold, which I think is extremely high. On the day of the sell-off, that same investment bank, a different individual mentions, have we hit a bubble? So with all this news out, I wouldn't put it past a hedge fund that saw the weakness at an all-time high and stalling and take on a short position. And with that, people don't really look, why are we coming off? They just know we are coming off and I need to get out. So trend following funds like CTAs, weak longs that obviously can't take a certain amount of pain. They just got in and they're out $200 in a week or two. I think they all exited. And I think it's extremely healthy for the market to have sell-offs. And as I said, nothing goes linear, but I believe that we're in a long-term rally still.
Interesting. Okay, so a bit of we had a guest on earlier this week. They called it almost a meme stock moment, right? All of a sudden the mainstream's talking about this story that we've been talking about for years. The data didn't really line up with panic selling by long-term holders. ETF outflows were limited and physical premiums barely moved, it seems. So, was this really a future-driven event? Maybe that margin call cascade inside the paper market rather than, the fundamental rejection of gold itself?
Yeah, no, I believe that, what you have to look at is who are the holders of gold and who are the biggest holders. First, the central banks. And 18% of whatever's been produced from day one in this world to now is held by central banks. And they are major accumulators with very deep pockets. I mean, I've dealt with central banks over decades, and not one central bank ever said, I am buying or selling because of the price today.
Right.
They make a policy. Should I buy? Should I sell? And then they stick to that policy. If you take a look, the World Gold Council recently did a survey on central banks. 75% of the central banks said, I'm going to continue to buy gold for the next 5 years. So the deep pockets, and we have a strong fundamental base. But like you said, the meme stock part that's the momentum trade, that little extra froth that was not very positive for the market and got away with itself. And I think that's what we've seen in the correction recently.
Interesting. I got to talk about the institutional thesis and kind of its credibility. I mean, on the JP Morgan report that I talked about off the top, the core of their argument is that the 60-40 stock and bond portfolio is broken. What was the final straw? I mean, why, after decades of functioning, has the market's trust in government bonds as a reliable hedge completely evaporated?
Yeah, this again goes back to general economic and geopolitical uncertainty. I guess you could say it started initially with Ukraine war. I mean, we started getting a bid, and actually certain ECB central banks started buying gold, especially like Poland and so forth, right after the Ukraine war. So it's not shocking. And I believe that if you take a look at the ECB, for instance, they just announced that the number 2 holding in their reserves is gold and surpassed the euro. So if you think about that, they hold more gold than they hold their own currency on the ECB central banks. If that doesn't scream buy gold, what does?
Yeah. And I mean, I hate to keep bringing up your former employer, JP Morgan, but it has a long and complex history in the precious metals market, including paying nearly $1 billion fine for manipulation just a few years ago. I'm curious because the audience kind of wants to view this as this hyper bullish report as a genuine research call and not just as a strategic positioning piece. But what do you think it is? I mean, could they just be talking their own book, setting the stage for their clients before a major move?
Yeah, I mean, I really can't get involved in that. I mean, research was independent of, and always should be independent of trading. So they put out their own thesis. I don't believe it's connected to the trading desk. And I also haven't been at JP Morgan in over 10 years, so I can't really even talk on behalf of JP Morgan.
Yeah, on that math, I mean, the allocation shift from that 2.6 to 4.6% for gold. I'm curious, I mean, from a Bullion's desk perspective, is the physical market infrastructure, the refineries, the vaults, the logistics, even capable of handling that scale of reallocation from the multi-$100 trillion bond market without, complete and chaotic price reset?
In gold, it definitely is. In silver, this is what's created part of the tightness. If you take a look, the other part of why gold is where it is not just the ECB is diversifying. The entire central bank world is diversifying away from the dollar, and they're doing that via gold. Gold has become not just a safe haven asset that it always was, but in my mind, it's now the ultimate safe haven asset in this world. And you see China and Asia bolstering their gold reserves. China is trying to become the third international hub in gold. They've done so many different things. They're allowing their top 10% of insurance companies to invest 1% AUM in gold. That estimate's almost $25 billion. They're relaxing rules and trading on the SGE and the SHFE. They're opening up vaults. They're trying to attract central banks, which I don't think they'll be successful in storing gold there. But if you take a look at the regions, Asia, Middle East, Europe, all the central banks in the world are diversifying away. And it to me is more economic uncertainty than geopolitical, in the sense that since President Trump has come in, and I won't get involved in giving an opinion on the administration, other than that they're quite inconsistent and flip-flopping. Tariffs yes, tariffs no, and aggression as far as military, so forth. So I think a lot of countries around the world are quite nervous, and therefore this rally is different than any other rally we've ever had, because there's a structural change in the investment in gold, and that's with central banks who are very deep pockets, and that's why I believe that we will continue with the U.S. administration not being clear on what they want to do, and with that, I think that this continued diversification will happen.
I wonder, we were chatting about central bank buying, and obviously you've talked to many of these central bankers in the past, and they're not really price sensitive. No one's looking at the price of gold. I'm curious, do the central banks, I wonder if they're going to start looking at the price of silver? I mean, there's always talks on X, and there's all these mummerings about India starting to pick up some silver for their central banks. But is that ever a discussion that's ever crossed near or something you've heard of?
Yeah, I've spoken to several central banks, and you have the one-off central banks that will look at all types of investments, outside of the normal. But the bottom line is, I think that they consider gold the international. It's a non-fiat currency. So it's not the faith of any country. And I think that's what they look upon as gold. I don't think you can say that with silver. So I don't believe that central banks will buy silver. However, I do believe that institutions will buy silver, especially pension funds and institutions that missed out on or are in the gold, and they don't want to buy more gold at this all-time high. I think they're starting to look at silver. I had a very large pension fund contact me for my opinion on purchasing silver and how to go about it and so forth. And I don't think they'll be the only one.
I wonder how do you go about that? I guess it brings us to the physical market. We can kind of transition here, Bob, because obviously it's the plumbing of the market itself. Because if hedge funds are leaning short while central banks are still taking delivery, I guess the real question is where's that physical metal coming from? I mean, you've been tracking what looks like an unprecedented drain from the COMEX vault system. More than 27 million ounces of silver gone in just 2 weeks. Is this simply metal moving to meet delivery demand overseas? Is it the exchange facing a genuine liquidity crunch?
Yeah. So, I mean, again, this is much more silver related than gold related, because the bottom line is the bullion banks, and bullion banks are the intermediary for the gold industry. I mean, they're the ones that finance mining companies, they finance fabricators, refineries, end users such as jewelry companies like Tiffany's and so forth. They lend metal to them and so forth. So I think that there's enough gold in this world that if they needed gold, they can go to central banks to borrow gold. However, that's not the case in silver. There is no lender of last resort. Right. And that's that's the problem we've seen. Prior to the threat of tariffs, there was roughly 250 million ounces of silver in the CME warehouses. Then all of a sudden, initially, I believe President Trump put tariffs on Canada and Mexico. Mexico is the largest producer of silver in the world, and that's what started this whole process of premium of silver, premium of the U.S. over the rest of the world. If there was a 10% tariff at today's price of $50, you would have to pay $50 to buy the silver and then $5 to import it. So therefore, you started this location of $55 silver in the U.S. and $50 the rest of the world. So what happened was, first, banks lost money because the EFP drastically moved. And then the spread continued so wide that banks were able to make back some of that money by taking delivery of silver in London, sell it by a mechanism called the EFP, where you buy spot London and sell futures. And if you're going to buy London and sell futures at a yield way above the cost of money and way above the cost of borrowing metal, you're then just going to take that delivery of London, ship it into the U.S. and lock in a profit because you have a huge differential. And that's what happened. We went from 250 million ounces of silver in the CME warehouses to 530 million a few weeks ago. And arbitrage is something that goes two ways. So then when the price coming off, and then with lease rates going to 150% for overnight, 25% for 2 and 3 months, the EFP for silver went the other way, where spot London became a $3 premium to December futures. Now, December futures should always be higher than spot London because there's a time difference. We're in October, and December futures obviously starts, the 1st of December. So what happened was banks were able then to sell spot London, buy back their short CME position, take delivery of the CME, and start shipping it over. And that's what we've seen in the last 2 weeks. We went from 530 million ounces to approximately 501 million today. So that roughly 29 million ounces of silver has been shipped out of the States. I don't know yet if it's all gone to London. I doubt it all. Some has probably gone to terminal markets like India as well. But this concept of the arbitrage reversing itself has put in the minds that the market should self-correct. I believe that we need another 100, 150 million ounces physically in London for us to normalize. And the reason for that is, if you take a look at Dan Gali at TD did an amazing study. I think you've probably had him on before.
Yeah.
He's the one that came up with this. Is this the silver squeeze worth buying into? And he was 100% right. I was with him 100% of the way since November. And what happened is he analyzed free-floating silver. So the simple explanation of that is you take a look of how much silver is in the London warehouses. And I think it's approximately 800 million ounces of silver physically in the London warehouses of the banks. However, a portion of that is allocated and can't be used. So the question is, how much free-floating unallocated silver there was? When he did the study, there was 305 million ounces of free-floating stock. To give you an idea of what that means, the daily trading volume was probably around 250 million ounces. So if you have 305 million ounces and there's 250 million trading, you have enough silver, and therefore things are going to be liquid. And silver forwards were close to money because of that. Then all of a sudden, you got drained with silver going to the CME, you got drained with silver going to India, you got drained with silver going into ETFs, and that free floating stock went from 305 million down to maybe 125 million. And the daily trading volume that was maybe 250 million probably went closer to 275, 285 million ounces. And that has what's created this entire tightness, is because there wasn't enough silver to trade on a daily basis to satisfy all the deliveries. And eventually, whoever was lending into this market eventually had to cover, and other banks had to cover, and there was panic. And I'm sure compliance and risk departments came into the banks and said, hey, we saw what happened in COVID. We saw what happened earlier in tariffs. Get out. So that exasperated it. Banks started taking less risk, started widening their quotes, and that also funneled it. So like if, for instance, a 2-month silver forward was quoted at 50 basis point wide, now they started getting quoted 10% wide. And if somebody borrowed at 10% wide, then you would shift that market another 10%. So this is what explains why the silver market panicked, and also with the amount of risk that was taken, which wasn't much, why we got to what I call the market broken.
Right. Okay. Well, I mean, one of the things I heard you say there is London, it needs about 100 to 150 million ounces just to kind of function smoothly. That's not a trading issue. I mean, that's a synthetic shortfall. Does that mean we're at the point where the pricing mechanism itself could break unless that metal appears?
No, I don't think it has an impact on pricing as much as it has an impact on liquidity in the forward market and the leasing market. Okay. I believe that eventually that liquidity could come back. Another way banks have recently developed some liquidity is they They borrowed the SLV, the ETFs, and they borrowed the stock, paid a fee to borrow the stock, then took that stock that that has allocated metal. For those of your customers that wonder, is there really allocated metal? Yes, there is, and banks have actually borrowed the stock, redeemed the stock for physical, and that also has helped inject a little liquidity into this market. Except for I still believe that if we're going to normalize to where we were a couple of months ago, I still think that we need that free-floating stock to equal the daily trading. So that's why I come up with my number of and I'm not the expert on how much is free floating. I've been going off of Dan Golly's numbers, but let's say make up it's 125 million and there's 275 million trading on a daily basis. You really need to get to that number of free floating in London for it to become liquid and normalized. The price obviously will fundamentally be supported by this shortage as well, because if you can't finance by leasing metal, you're going to have to go out and outright buy it.
Yeah, so interesting. I mean, it sounds like the futures market becomes the only release valve left. I mean, how much real liquidity is actually left in the futures market at this point? We're seeing thinner books, wider spreads. Some brokers are even talking about reduced delivery capacity. Is the paper market still functioning as a true hedge, or is it now just a placeholder for metal that isn't there?
No, I mean, it works because you're still hedging. I mean, obviously, the dislocation's constantly changing. I mentioned the EFP. The EFP could move 50 cents at a clip, and the price could move 50 cents a clip. And that's what's created this volatility. And volatility brings large sell-offs. So I think it's a self-fulfilling prophecy, but I think that things can normalize. The big question in my mind on silver is the 232 analysis that's coming out. The 232 analysis is a critical mineral analysis on silver. And the difference between silver and gold is that silver is used much more on an industrial basis. Solar, PVs, AI, EVs, data center microchips. If the U.S. puts a tariff on silver, then all of a sudden the silver will stop moving, because you're not going to move silver that's $5 more in value to a market that's $5 less. Yeah. So all the shipments will stop. So the key is, one, will tariffs be imposed? And if they are, then that's a problem. The issue with putting tariffs on silver is, one, it's a monetary metal. And two, if you look at why the U.S. wants to put tariffs on, for instance, I understand why they may want to put a tariff on Chinese automobiles, because they want to foster more U.S. production. And if you put a tariff on autos coming out of China, then that will foster more production in the U.S. for automobiles. However, if you put a tariff on silver, it will not produce 1 ounce more of silver in the United States. For instance, 30%, less than 30% of the silver mines are dedicated silver mines, so where you would go in and extract actual silver. The rest is made by byproduct. So 70% of the silver mines are byproducts. So you're not going to increase that production for a byproduct. So not 1 ounce of silver will be increased. So the analysis of putting a tariff on a critical mineral will only do a disservice to the United States, because, as I mentioned, how many different industries in the U.S. require silver as a critical mineral. So I'm going to assume that they don't put a tariff on it, but until this analysis comes out, and unfortunately the U.S. government is closed, so we don't know if it will be coming out, because it should be out. It should be out by today.
Mm-hmm. Yeah, I was reading reports today about Section 232 and that critical minerals analysis. They're saying maybe early as next week. But you talked a little bit about why that review is so important. But if silver is formally designated as a critical mineral, I mean, what does that actually change for the market? Does that mean that the U.S. government could move to secure domestic inventories or restrict exports in the name of national security?
I mean, I would be surprised if they did that. I mean, but I don't really know what's behind the thought process of the government when it's coming to tariffs these days. But I would think that as a monetary metal that silver would not be tariffed. But I really it's anybody's guess what will happen if it is tariffed.
Yeah, I was good because I mean, that kind of classification would effectively pull silver out of the normal supply chain and kind of force exchanges like COMEX to coordinate directly with Washington. It feels like at this point. I mean, it seems like bigger stories here.
Yeah, no, I think like I said, all eyes is on the analysis, and hopefully we get clarity.
Yeah, well said, Bob. Okay, let's switch over. I mean, we established that there's that insensitive, I guess we could call, buyer in London. Who's the seller? I mean, who's standing on the other side of this trade, willing to give up physical metal during a historic drain? I mean, is it just the arbitrageurs, or are there entities, perhaps funds, and those margin calls a little bit that we were talking about, who are being forced to sell that physical metal into the tightness to raise cash?
No, I think it's much more the opportunistic profit motive of banks to. Okay. I mean, if you could sell London spot silver at $3 over December futures, and then you could go in and, let's say, borrow the metal for the time that takes to physically deliver it. It takes most silver is, first of all, done by boat. And the reason for that is the weight and the density. But you can ship silver by plane. The only thing is you're limited to 250 to 500,000 ounces or so. And so you can't move large volumes by plane. But as that spread widened, it made sense even. I think if from my old days, it's like 8 to 10 cents by boat and maybe 15 to 18 cents by plane an ounce. So as it widened out, it allowed you to move the silver physically by plane and as well as boat. So if you could sell silver at $3 premium spot to futures in London, and let's make a number up and say with cost of shipping, the cost of borrowing the metal for the time it takes, because you're selling spot silver that you don't have. Now you have to go and borrow that silver. And that's what happened with that's why the OTC also got so tight, is because all these banks were taking advantage of this arbitrage and more borrowing came in. So if you're able to do that, and let's say, for instance, make $1 an ounce on 1 million ounces, that's $1 million. If 30 million ounces move, that's $30 million. So now you understand the economics of why the banks would do this. So,
yeah. I mean, good ROI on a little bit of I guess just a little bit of a delivery thing there. Lou, you're talking about London. Let's turn to London, because the LBMA's new chairman, Peter Zollner, is floating the idea of reviving a London gold futures contract to compete with COMEX and, in his words, restore liquidity to the system. I mean, you had a little bit of a post here, Bob, I was reading on LinkedIn, but talking about maybe this not being the solution. What London really needs is for CME depositories to be approved inside the London's clearing network. Explain why that structural change, not another futures product, would actually solve the liquidity problem.
Yeah, first of all, we don't know how successful. I mean, they've tried several times. The LME tried to put up a futures exchange, and it failed because COMEX, the CME, I should say, is quite liquid, and people are used to it and trading on it. So why reinvent the wheel and start a futures exchange and have a great chance of failing when the fact is it's the physical movement of metal that, and I suggested during COVID times, they were looking at it as that would be the, when refineries closed and airlines stopped flying, I suggested to the CME and to the LBMA that you should, and I was trading during that time, that you should open up depositories in London where the CME would open up a second contract. It would be a 400-ounce bar contract versus a 100-ounce bar contract, because London trades 400-ounce bars. Mm-hmm. And so therefore there would be a slight premium difference to the 100-ounce bar contract, but it would immediately inject the liquidity you need. You wouldn't necessitate these physical shipments back and forth, and I think the market would react a lot more orderly.
Okay, so you explained it there. I mean, COMEX and LBMA, they almost operate like separate islands. And if CME-approved vaults were integrated in London, metal could flow directly between these two hubs instead of being arbitraged through paperwork. So would that single change and these chronic dislocations, end these chronic dislocations that we've seen between spot and futures?
Yeah, I think it would greatly reduce these dislocations. Again, you would probably have a difference between a 100-ounce contract versus a 400-ounce contract. But once people started trading that 400-ounce contract and it became liquid, then you had the CME depository metal commingled or next to the London regular OTC metal, and then it just becomes a physical book transfer between where it's being stored for.
Yeah. I got to ask you about the Platts. I don't know if you've been keeping an eye on it, but now that I have you, Bob, and we don't get you often, I just want to ask you about your thoughts because, I mean, we got these new sanctions targeting Russia's energy giants. And given that Russia is a critical supplier of platinum and palladium, I'm curious about what your thoughts are here. We've also seen some of these discussions about kind of a squeeze on the platinum market, if you will, as well. Are you seeing any tightening there? Are you hearing any mumblings?
Yeah, I haven't been focusing as much on platinum and palladium, but yes, platinum. Yeah. I mean, platinum and palladium are significantly less liquid than gold and silver, so it's much easier for the dislocation. The other thing that I've been advocating for several months now is that the London precious metals, the platinum market. The organizations, they become a little more transparent, just like the LBMA, and they announce on a monthly basis what actually is in the warehouse. For instance, the LBMA puts out statistics on how much gold and silver in the warehouse, how much trade every day. We don't have any statistics in London on how much platinum and palladium is there. I believe that at least that transparency would help somewhat. And the question is, why aren't they doing that unless the situation is a little more dire than it was in the gold and silver market?
That's interesting. Is it just to create a little a little upward trend here? I mean, these little squeezes, they saw how easy it was with the silver market or how hard?
Yeah, I think that, the fact is, the PGMs are less liquid because there's, less available. Yeah. And also, as you mentioned, South Africa and Russia are critical to the liquidity. And if you take out Russia, that will have some impact on further liquidity.
All right. Just a fascinating story. We got to have you back on. We could do it this way. I mean, if we put all of this together, Bob, the physical drain, these institutional motives that we've been talking about, and then, of course, adding on the geopolitical pressure, is the Western paper price becoming a lagging indicator? I mean, is the true price now simply the physical cost to source and deliver a bar in Shanghai and Mumbai?
Well, that's a good question. I believe that, first of all, specifically China, their agenda is much bigger than just accumulating gold. As I mentioned, all the reasons, earlier in the segment, I believe that, they're trying to bolster their presence. One, to have, I think the Far East want to have more of a impact on the price, because right now, the price is determined by the London spot market and the U.S. futures market. So they are trying to open up more to have also become the third international hub and impact the price as well because of that. And why are they doing all these things? Especially China, I believe they're trying to do this to bolster the renminbi, and they also have probably a bigger agenda to surpass the dollar and weaken the dollar by becoming a stronger hub in gold and having the rest of the world central banks do the same.
Yeah. Fascinating. I wonder, I mean, besides what we kind of know about the Far East situation, what are those concrete levers that China's pulling to move precious metals price discovery out of London and New York? I mean, is it custody and vaulting in region? Is it more of those yuan settled contracts or exchange linkages, outright control of refining and logistics?
Well, first of all, China is the biggest supplier and demand in the world, meaning that the biggest supplier because they're the biggest producer of gold in the world, and they're the biggest demand. Between all the public buying and the ETF buying, one of the reasons why gold is so important to a country like China is because there's not many financial assets that people can turn to, and that's another reason why we've had the rally we had in the last year or so. Is traditionally, when, for instance, the dollar gets stronger, gold comes off. And in this last rally, if you take a look, when the dollar got stronger, China came in buying. Why? Because it was a hedge against their currency. And other countries also that have weak financial markets and weak currencies are buying gold when the dollar gets stronger against their currency. And then on the opposite side, when the dollar gets weaker, you have the West central banks that have been buying gold to diversify away, are also accumulating gold. So it's been a unique rally and different than any other rally because we've never seen it where when the dollar gets stronger, gold has been getting stronger. And so I think the dynamic is clearly that Asia, China, and the rest of the world are looking to supplant the dollar with gold and with the rest of their economic policies around the world.
Yeah, are we seeing that in the persistent kind of Asia time bids and the spot futures dislocations that you've been tracking? I mean, practically, what would flip the switch? I mean, a deep deliverable contract in Shanghai with transparent vault data, or maybe Chinese banks offering, term financing and leasing that undercuts London?
I don't really think that's the answer. I think gold, first of all, is a deep enough market that it doesn't have any. It really is not having any issues price wise. The EFP is much more normalized. Initially, we had that tariff threat, and what happened with gold was there was a tariff threat, and there was a tremendous amount of gold moved, and the banks went to borrow gold from central banks, and the problem was the Bank of England holds all the gold. And there was a bottleneck at Bank of England. And while lease rates went from 0 to 1% to 2%, and were on like 20-year highs, all the central banks wanted to lend the gold to the bullion banks because they wanted to enjoy this income on a non-interest bearing commodity such as gold. The problem was Bank of England's not a commercial vault, and a bottleneck happened, and they couldn't get the gold out of Bank of England physically into the custody of the clearing members in London. And that created a bottleneck that went from 2 days to 2 to 3 months. And that's what initially created that problem. That market has now quieted down and liquidity has come back. But that's the issue we're having in silver.
Oh, man, we could talk all day, but of course our time is almost up. Let's finish with what you're watching now, Bob. I mean, because after everything we've seen this quarter, I mean, the next few months could be decisive for both the metals and the broader financial system. What are the key signals that you're kind of tracking between now and year end? Is it the COMEX vault movements, Asian buying patterns, lease rates, or something else that kind of will tell us where the market goes next?
Right. Well, I believe that a couple of things are important. One is obviously the policies of the United States. For instance, another thing I forgot to mention, that one of the things that might have triggered the sell-off the other day was President Trump mentioned that there would be a good resolution to China trade at the end of the month when they have those meetings. And basically what that translated into, well, there's less economic uncertainty if, in fact, they resolve all the trade issues. I don't believe that will ever happen because obviously China has a big agenda, and also I'm not sure that the U.S. will ever get into an agreement with China. But that's clearly something that's that you want to look at is the U.S. economic policies, the uncertainty, the relationship with China. I think that those are very paramount. A lot of people are discussing, the FOMC cutting rates being favorable to the price of gold, obviously. And finally, what I mentioned before, the central bank survey, according to the World Gold Council, 75% of central banks said they're going to buy gold over the next 5 years. And I believe that should continue. And as long as we see that continue, we're going to see a slow, steady offtake from deep pockets that will be fundamentally supportive to the price.
Yeah, well said. And I guess bottom line, I mean, where do you see gold and silver finishing this year? Do you expect this rebound to kind of hold and evolve into a sustained bull phase that we've already seen, or are we in for another round of forced liquidations before the next leg higher?
Yeah, well, I don't really get involved in forecasts per se, and I certainly don't get involved in forecasts on a time basis. I'm basically friendly to both gold and silver long term. But the problem is you never know why you have the moves. For instance, the first run up in 2020 was because of COVID. I don't think anybody in the world could have ever forecasted COVID. And then obviously we've had this craziness with tariffs and economic uncertainty of the U.S. I don't think we could have forecasted that as well. So I'm not really in the role of coming up with those forecasts because I don't believe we ever can. But what I do believe is that as long as the U.S. administration is going to flip-flop and also won't be able to predict their behavior, and I believe that the rest of the world is nervous of that, and they're going to continue that diversification away from the dollar into gold. So I think that's what you need to focus on, is that those patterns still continue.
Yeah, fundamentals haven't changed here. All right, Bob, a fascinating, incredibly timely discussion. Your breakdown of the physical market mechanics, the policy triggers, and the structural shifts give our viewers a perspective they won't find anywhere else. So we appreciate this. And for those who want to dig deeper into your research, your upcoming book, The Invisible Vault, is, let's talk about this book that you have coming out. I mean, where do you get it? It explores the market. I think it's out in February, no?
Yeah, it's not out till February. It's on Amazon and Barnes & Nobles and several others for pre-orders. So I'd be thrilled if everybody would look in the audience to buy it, because it's a good. It's first half of the book is somewhat of memoirs of all my trading involving with central banks and other organizations, but it also explains how bullion banks operate, and dispel some of the rumors of like paper gold and so forth like that, and how the markets work. And then the rest of it is on an educational basis. Why gold? Why individuals, the central banks buy gold? Demand supply factors, what products are available, and so forth. And it ends with my ultimate safe haven asset being gold.
Gold. You heard it here. All right. I appreciate it. Bob Gottlieb, thanks for joining us today, sharing your insights. Come and see us soon, okay? I mean, we just got into that topic. We hardly even touched a lot on gold. We were talking about silver majority, and I'd like to talk to you more on that side too. So we'll see you soon. I appreciate this.
No, I appreciate it, and thanks for the plug.
Yeah, of course. All right. Gold, silver, now platinum too. 3 markets moving under pressure with policy shifts and liquidity stress, redefining how investors think about risk and, of course, value. Now, we're going to keep tracking these developments and the physical flows driving them. For all of us here at Kitco News, I'm Jeremy Szafron. Thanks for watching.